So you fall into the 22% tax bracket, but your effective tax rate is only 9%. How does that work? Hi, I'm Garrett Ray, financial planner here at the Wealth Guardians and the Ray Financial Group.
And I'm Brice Payne, and you've entered The Vault, the Wealth Guardians video series on all things pertaining to retirement planning. In this episode, we're going to talk about the difference between an effective tax rate and the tax bracket that you fall into, and how a standard deduction plays a role in both of those. Don't forget to hit the like and subscribe buttons down there below if you're so inclined to catch future episodes of The Vault. And okay, Garrett, let's go ahead and get started on this. What is the difference here between a tax bracket and an effective tax rate?
Yeah, so Brice, I think the best way to help illustrate this is let's just bring up our graphic here and show an example. And in this case, we've decided to highlight a married couple filing jointly. In the past year, they earned $77,700 of gross income. Okay. Now, we have to factor in what's their standard deduction. So the standard deduction going into tax season 2023 for a married couple filing jointly is $27,700.
Okay.
So we take that $77,700, subtract the standard deduction, and now we end up with $50,000 of taxable income.
Okay. So before we go any further on that, just to be clear, that standard deduction, if somebody, that's all they made,
right,
they basically don't owe Uncle Sam a penny in taxes.
Correct.
Because that's the first amount that they make that they don't have to pay any taxes on. If you make beyond that, that's when we start talking about tax brackets.
Correct.
Okay.
Yep. That effectively that first $27,700, if you're married and filing jointly, is tax free.
Okay. Yep. And then there's different numbers if you're filing individually, but we're just doing this as a simple jointly one. Okay.
Just an example.
Very good.
So now we've got our taxable income of $50,000, and this is where Uncle Sam starts to go to work. So let's go back to our graphic here. Let's look at how they calculate this. So the first $10,275 is taxed at the 10% tax bracket, okay? We've done the math for you, and that's $1,027.50 of tax. Then we've got the next $31,500. That's the difference between the 12% tax bracket, which ends at $41,775. So $41,775 subtract $10,275. That's the math here. That's at the 12% tax bracket.
Okay.
Okay. That tax comes out to $3,780. Then we've got to get to the $50,000 taxable income. Well, that difference is $8,225, and that is what is taxed at 22%.
All right.
Okay. So if we go all the way to the bottom of the graphic here, we got to add up the different taxes at each bracket. So we've got $1,027.50, $3,780 from the 12% tax bracket, and then $1,809.50 at the 22% tax bracket. So if you add all of that up and then divide that by what they earned in the year, which of course was the $77,700, then their effective tax rate is 8.52%.
So basically there is a misnomer out there that somebody thinks, well, if I thought I was falling in the 12% tax bracket, but I made $1 too much, and now I fall into the 22% tax bracket, a lot of people out there will think, well, now all of my earnings are no longer being taxed at 12%. They're being taxed at 22%. And this was a terrible deal for me to have made that $1 extra. But that's really not the way it works. What you're saying here is that you still have the first $20-some thousand dollars. It was a standard deduction that wasn't taxed at all.
Right.
And then the next portion of your money was taxed at 10%. And the next portion was taxed at 12%. And then a little bit was taxed at the 22%.
Correct.
So you weight all those together, and that becomes your effective tax rate, even though technically speaking in this example, the person fell in the 22% tax bracket. They didn't effectively pay a 22% tax on everything that they earned.
Exactly.
Okay. So that is the difference between an effective tax rate and the tax bracket. And we wanted to point this out to you because a lot of people out there think that I've got to do whatever I can to not pay 22% in taxes. And that's really not what you're paying. That's just a little bit at the end there. And of course, you go from 22 to 24%.
Of course.
It's up into the 30s from there. So that's a quick explanation on the difference between an effective tax rate and the tax bracket that you might fall into, and how almost always that tax bracket sounds scary, but that's not really what you were paying in taxes. So, Garrett, did we miss anything? Did we cover everything for everybody in that one?
You got it, Brice.
All right, very good. Well, again, thanks for tuning into this episode of The Vault. Don't forget to hit these like and subscribe buttons if you're so inclined. That's going to wrap it up for this episode. Remember, as always, the markets aren't going to wait for you. I'm Brice Payne.
And I'm Garrett Ray.
And this has been The Vault.